Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic I want to discuss with you defined benefit plans fully explained. And I want to go over some of the pros regarding a defined benefit plan, some of the cons that individuals make some mistakes with when setting up their defined benefit plans, and then essentially, if you're not offered a defined benefit plan, how you could have access into a personalized defined benefit plan more on the private market. So there's a couple different ways to to kind of analyze defined benefit plans. In the very beginning, let's just start off with saying what exactly is a defined benefit plan. Now, what happens is typically an individual is offered, different slew of retirement accounts. They either have a defined contribution plan or defined benefit plan. When we break down these two words, we have to really understand what is defined benefit. Well, that means if you're working for a company, so we have an individual that's working for a company, and he's offered a defined benefit plan, then this means that the employer, so whatever the entity is that you're working with, if it's for the state, if it's for a federal entity, a private entity, whatever that is, if they offer you a defined benefit plan, then essentially what typical defined benefit plans do is this person's working for X amount of years, and they have set up in their employee benefits package that after they're done sufficing X amount of years of service, such as 25 years of service, then they are deemed retired. So now at that point in time, once they are deemed retired, depending upon what their age is at that time, or they have to some plans you have to wait until age 59 and a half, other plans you could retire before age 59 and a half, and it only goes off of years of service. At that point in time, now that employer is paying that individual a stream of income for either their lives or theirs and their spouse's life, for the rest of life, however long they live. So defined benefit plans, they used to be the norm back in the day. And, I always explain the example of my grandfather. My grandfather was an elevator mechanic for the city of New York. So part of his job description, or I guess part of his employee benefits, was that if he works for the city of New York as an elevator mechanic in the union for X amount of years, after he was done with that last year, they compute a certain calculation that says, okay, you started when you were 30 years old. If you give us 25 years of service, meaning when he's age 55, they're able to then calculate how much income he would receive for the rest of his life. So individuals with defined benefit plans, also known as a pension plan, are typically very happy because they understand that there's income that's going to be going to them for the rest of their life. They don't have to play that big guessing game right when they turn 60 years old or 65 or 66 of just trying to decide how much money can I properly pull out of my retirement account to make sure that I'm not outliving that money. So the defined benefit plan, they do that option for you, and all they're saying is, listen, focus on your job, make sure that you're working hard. Every year that you're giving us, and you could also include different things such as overtime that could be computed in that calculation. We'll make sure to set you up and give you a correct retirement check, so to speak, every single month to the day that you pass away. Now, one of the very common mistakes that individuals make with defined benefit plans is they try to say, okay, well, that sounds fantastic, and I feel as if I'm going to live a long life, so therefore, in my grandfather's case, he was going to trigger his option A regarding his defined benefit plan, his defined benefit pension plan. What that said was he would receive X amount of thousands of dollars every single year of lifetime income, but it would only go to his life. So he was 55 years old. My grandmother was 54 years old, and he was in the process of walking out the door, and she asked him, what was in your hand? He's like, oh, I just checked out, one of these things, checked off one of the things for my company regarding how I want to take my income option, when I retire. And at that point, they had a big fight. And she said, "How could you not put me on this? All this." So, long story short, she won the argument, and they basically chose option B. What option B did was they said, "Okay, well, rather than just covering my grandfather's life, they're going to cover my grandfather and my grandmother's life with income for the rest of their lives." So, at age 55, let's say that he was going to receive $60,000 a year of lifetime income on himself, or $50,000 a year for both him and his spouse, my grandmother. That's the option that they chose. So someone watching this video might say, okay, well, why is there such a difference? Why is there a difference of $10,000 from option A to option B? And this is the bad side to defined benefit plans, because with the typical pension plan or defined benefit plan, let's say if someone chose option A and they said, okay, it's for a single life only option. And with my grandfather's case, he's 55 years old. Let's say he chose option A and all of a sudden he gets paid $60,000 the first year, $60,000 the second year, and then all of a sudden passes away tragically, or just essentially just passes away. Well, now all the income is going to stop. So that's kind of the risk versus reward when you're setting up these types of income streams, or you're setting up your type of income payout, is to say, okay, well, when you pass away, there's not going to be a death benefit made out to your beneficiaries. Now, understand there's different options within a defined benefit plan, but that's going to be the most basic type of option that does not provide some sort of death benefit there. So that's why typically it's advantageous to say, okay, I want to make sure that me and my wife are both covered. God forbid if I pass away, then my wife would still be receiving income. So in this case, my grandfather passed away at a young age, at age 69, and then my grandmother lived into her 80s, into her late 80s, before passing away. So that little fight that occurred while he was walking out the door was probably the best thing that could have ever happened to her. Because she was still able to receive a lifetime income benefit, and then did not have to, go back to work while she was in her 60s and her 70s just to make ends meet. So it was a really good, aspect, and this was all set up through a defined benefit plan. So from 1974, you had a branch of the government that came out known as ERISA. It's known as it's ERISA, Employer Retirement Income Securities Act. And what happened was individuals were now, rather than saying, okay, if you work X amount of years for a company, we're going to provide you a defined benefit. That now went by the wayside, because there's a lot of risk associated with that company when they're trying to set up those defined benefit plans. With individuals that just keep living longer and longer and longer, well, then that company's going to have to be paying out more and more dollars, and there's going to be more risk trying to make sure that they're leveraging the max amount of dollars possible to get the most amount of benefit, to then be able to provide that benefit year by year by year. So because of that risk that was getting thrown on the employer, you had ERISA was the start of it. They created different things, different types of retirement accounts known as a defined contribution plan, and it became very attractive in the 1980s, such as a 401k account, or a 403b account, or a 457 account. Different things that say, okay, rather than give you a defined benefit, we're just going to define that you could contribute into a retirement plan. So that's why you're seeing, all these different retirement accounts that are invested within the stock market. So in the 1980s through 2000s, the markets were doing very well. You had over 1,000% growth in the market from 1980 through 2000. The early 2000, and individuals were essentially placing dollars, were setting aside money from their salary, placing dollars into a bucket. You had companies that were also matching into that bucket, and therefore this bucket, the way that this bucket grew was the amount of contributions and matching into it, and then essentially the percentage rate that was returned based upon mutual funds that 401k was tied to. So what happens, the bad side to a defined contribution plan, and I want to make my point with this, because individuals that have a defined contribution plan understand that you could get set up in a private defined benefit plan by leveraging those old 401k monies or IRA monies, or however you deem fit. So let's say in 2008, the average portfolio lost 57%. So you had individuals that were getting ready to retire. Some accounts had something as high as $1 million into their account. And these individuals took a 50% hit. Let's say if this individual took a 50% hit, just for easy math. Well, that 1 year, regardless of how much money or how much time they placed money into their bucket, and how many thousands of dollars were matched, with contributions, this retirement bucket dropped down to $500,000 worth of value in just 1 year's time frame. So they saw their entire retirement, their livelihood of saying, oh my gosh, okay, the market's always going to go up, to then saying, wow, this is very real. The market is nothing more than a gamble, than going to Vegas and playing roulette. So what happens with a defined contribution plan is individuals have this type of risk that's associated there. They have the risk of 401k related fees. They have the risk of mutual fund related fees that are already negatives hindering that account. And then most importantly, they have the downward market loss risk as well. So with a defined benefit plan, the individual is just working for the company and saying, okay, well, when I hit X amount of years of service, I'm going to be receiving X amount of thousands of dollars every single year. So right when somebody either severs employment, or they might hit 59 and a half, or they change jobs, or they have it in IRA accounts, there's ways on how you could take dollars from a defined contribution plan and you could roll it over into a specifically designed IRA contract that mimics how a defined benefit plan works, but has a little bit extra benefits to it as well. What do I mean by that? Well, what happens is with a typical defined benefit plan, we understand that you're giving up your access to that money. You're giving up a death benefit because you're receiving an income stream for the rest of your life, for yours and your spouse's life. When one spouse passes away, the other spouse will continue that income. When that second spouse passes away, then there's nothing left as a death benefit. Now, when you have a defined contribution plan, you can get set up making sure that you're eliminating the mutual fund related fees, the 401k related fees, and most importantly, the downward market losses to your portfolio when you roll it over into a properly designed IRA contract. And then on top of it, you could attach something known as an income rider to those IRA contracts that will provide you lifetime income in 2 years, in 30 days, in 10 years, whatever that case may be. And there's a specific guarantees that are set up through these companies that say, okay, if you go and you trigger your lifetime income at age 65, you're guaranteed X amount of thousands of dollars, every single year for the rest of your life. Now, rather than having that income stop, or let's say the same case with my grandfather, let's say he was 60 years old and he's getting paid $60,000 from one of these specifically designed IRA contracts. If he was to pass away after a couple of years, whatever was remaining in his account value that he did not pull from, that would go to his beneficiaries. Now, if he kept living, and let's say he exhausted his IRA bucket, well, now the company is still on the hook to pay him $60,000 for the rest of his life. So even if he lives to his hundreds, for the rest of his life. So there's certain things that you could do, and there's been so many innovations regarding these types of financial plans and these types of financial products, especially after 2008, that you should always be mindful of what those plans are and how to best execute them, or whether or not they may suit your specific needs. So a couple of things we learned with this video is, with a defined benefit plan, typically individuals that have them are very happy because they understand that there's going to be income coming to them for the rest of their life. They could live their retirement years with confidence because they know that that retirement check is going to keep coming to them month by month by month. But there are some risks involved with the defined benefit plan. Those risks that are involved are the death benefit. Essentially, you're not leaving a legacy to your loved ones, or you can't leave an accumulated account to your loved ones depending upon which option you chose off of the defined benefit plan. A really quick example, or a really quick solution off of this, when I was giving the example with my grandfather's single life only option or the joint life only option regarding the pension plan, is there's a $10,000 difference right there. What could have happened was they could have said, okay, I will go 100% into the single life only option for $60,000, and then we take a life insurance policy out on my grandfather to make sure that as $60,000 is coming to him, $60,000 is coming to him, maybe the life insurance policy costs $5,000, and that's now going to provide $300,000 worth of a tax-free death benefit to my grandmother. To say, okay, let's say if he keeps living, they're netting that $10,000 worth of, or sorry, $5,000 worth of difference, and then God forbid whenever he passes away, now my grandmother has access to $300,000 of a lump sum benefit that she could now place into one of these private defined benefit pension plans. So there's a couple of different ways to set that up properly, but understand, depending upon what your situation is, going to be entirely different than the next guy. So you have to make sure that you're setting it up properly, you're being educated on what are the best options out there for your specific state, for the dollar amount that you're using, for the lifetime income that you want to see happen, so that you're just maximizing your benefit as much as possible. So in closing, I hope that a lot of this made sense. I hope that you learned some things, regarding the defined benefit plans, and if you're currently in a defined contribution plan, that's not necessarily a problem, because you could actually leverage those accounts better and have that safety aspect and have that lifetime income stream that individuals that have defined benefit plans have. So, once again, my name is Derek Afasi. I'm the owner of Afasi Financial Group. We are A+ rated on the Better Business Bureau. And what we do is we have specialists standing by that try to help educate you first and foremost of saying, okay, listen, I have a defined contribution plan. I'm looking to potentially roll over that money to have that defined benefit plan aspect, or I have a defined benefit plan. I'm coming very close to deciding how to take out this income. I need some, advice on, how to do this properly. And that's what we're here for. We offer 24/7 customer service. Our 1-800 number is 1-800-566-1002. You explain the situation to the assistant that answers the phone, and then they'll patch you over to a specialist. One of the things is a couple years back, I implemented the 24/7 customer service because I understand the national volume that we get. And, we've had all very good reviews. We've never had any complaints because of this methodical process, making sure that education is first and foremost. And you have to be educated before you can make a decision on which plan would suit your needs the best possible way. And when individuals unfortunately make that mistake of going the wrong route, it costs them thousands of dollars in retirement, by just that lack of education on what were some of the best options out there for their specific benefit. So I want to thank you very much for watching this video. Feel free to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks, guys.